Your financial advisor is not working for you, they're working for the institution that pays them. And those two things are not the same. I know that's uncomfortable to hear. I know some of you have a financial advisor you genuinely like, someone who seems knowledgeable, who sends you a quarterly report, who smiles when you sit down together and says everything looks great. I'm not saying they're a bad person. I'm saying the system they operate inside has a fundamental structural conflict of interest with your long-term financial freedom. And most people never figure that out until it's too late to do much about it. Here's the number that should make you pause. If you invest $100,000 in a mutual fund with a 1% annual management fee, and that fund grows at 7% annually for 30 years, that 1% fee costs you approximately $180,000 in lost compound growth over that period. 1%. That number isn't controversial, it's math. And here's the question nobody asks. Did your financial advisor tell you that on the day you signed the paperwork? Did they show you the 30-year projection of what their fee would cost you? Did they explain the alternatives that don't carry that fee structure? They didn't. And today I'm going to tell you exactly why and what to do about it. Let me tell you about a conversation I had in my early 30s that changed how I think about financial advice forever. I had just started making real money for the first time. My nylon and Velcro wallet business was doing well. I had more cash than I'd ever had in my life, and I was genuinely uncertain what to do with it. I wasn't financially sophisticated enough yet to feel confident making decisions on my own. So I did what everyone tells you to do. I went to see a professional. The financial advisor I met with was impressive. Nice office in Honolulu, credentials framed on the wall, professional suit. He spoke with complete confidence. He walked me through charts and graphs and historical return data. He recommended a diversified portfolio of mutual funds, domestic equities, international exposure, the bond allocation. He talked about the power of compound interest, the importance of staying the course through market volatility, and how this strategy had produced reliable results for his clients over decades. I left that meeting feeling good, taken care of, like a responsible adult who had made a smart decision. About 3 months later, I went to visit Rich Dad. I told him about my financial advisor. I told him about the portfolio. I was proud of myself. I expected approval. He was quiet for a moment. Then he asked me one question. He said, "Robert, what does your advisor earn when your portfolio goes up?" I thought about it. He said, "And what does he earn when your portfolio goes down?" I suddenly realized I didn't know. Rich Dad nodded. He said, "Find out." I found out. The advisor earned a management fee either way, a percentage of assets under management. Regardless of performance, my portfolio could lose 30% of its value, and his income from my account would decrease, but only by 30% of his fee. He still got paid. He got paid whether I won or lost. Rich Dad said something I've never forgotten. He said, "Robert, never take financial advice from someone who gets paid regardless of your outcome. Their interest is in managing your money, not in making you free." I went back and looked at the actual costs buried in those mutual fund documents, the expense ratios, the front-end loads, the management fee on top. I ran the math. I was genuinely shocked. Over a 30-year horizon, the fees on that portfolio would consume a meaningful portion of what I was trying to build. I moved that money not recklessly, but with open eyes. I started building real estate. I started acquiring assets that paid me directly without a middleman extracting a percentage of my wealth every quarter, just for being in the room. That moment sitting across from Rich Dad, being asked a question I couldn't answer about my own money, was the beginning of my real financial education. Here's the lie the financial services industry needs you to believe. Investing is complicated. Markets are unpredictable. You need a professional to manage your money for you. Don't try to do this yourself. And that statement has just enough truth in it to be effective. Markets are complex. There are real risks. Professional knowledge matters. But embedded in that message is something else entirely. The idea that your best path to financial security is to hand your money to someone else and pay them a fee to manage it for decades, for the rest of your working life. Think about what that actually means. You spend 40 years working. A portion of every paycheck goes into a retirement account. That account is managed by professionals who earn their fee whether the account grows or shrinks. The tax-advantaged account limits how you can invest within it, mostly to stocks, bonds, and mutual funds. You cannot easily hold real estate in it. You cannot easily hold gold in it. You are, for practical purposes, entirely inside the traditional financial system, paying its participants to manage your participation in it. And at the end of 40 years, you hope it was enough. The rich do not do this. Let me be very clear. The genuinely wealthy do not primarily rely on a financial advisor managing a portfolio of mutual funds for their financial freedom. They own businesses. They own real estate. They hold real assets outside the traditional financial system. They use financial advisors as one input among many for tax strategy, for legal structuring, for specific expertise, but they do not outsource their financial thinking to them. Here's what your financial advisor almost certainly will not tell you. That many actively managed mutual funds underperform their benchmark index over long periods. That the fee structure built into most financial products is designed to benefit the institution first and the client second. That there are asset classes, real estate, private business ownership, certain alternative investments, where the wealth building potential significantly exceeds what a standard managed portfolio offers, but that your advisor has no incentive to mention because they make nothing. When you buy them, the advice you receive is shaped by the incentives of the advisor. And the incentive is almost always to keep your money inside a system they're paid to maintain. Knowing this doesn't make you anti-professional advice. It makes you a more intelligent consumer of it. Rich Dad used to say, the most expensive advice in the world is free advice from someone who doesn't have skin in the game. And the second most expensive advice is paid advice from someone whose payment is disconnected from your outcomes. Let me teach you the framework Rich Dad gave me for evaluating any financial relationship. He called it the alignment test. 3 questions, simple, ruthless. These 3 questions will tell you whether any financial advisor, any fund manager, any professional is actually on your side. Question 1, how do they get paid? Not how much. How is it a flat fee for specific advice? Is it a percentage of assets regardless of performance? Is it a commission on products they sell you? The payment structure reveals the incentive structure, and the incentive structure determines what advice you actually receive. A fee-only financial advisor, one who charges a flat fee or hourly rate for advice and earns no commissions or asset management fees, has a very different incentive than a commission-based advisor or an asset manager. A fee-only advisor's income depends on giving you advice worth paying for. A commission-based advisor's income depends on selling you products. These are fundamentally different relationships, and conflating them is a very expensive mistake. Question 2, do they personally invest in what they recommend? This sounds basic. It is basic, and it is shocking how rarely people ask it. If your financial advisor is recommending a particular mutual fund, do they own it themselves? If they're telling you the stock market is the best long-term vehicle for your retirement, is that where their own wealth is held, or is their wealth in a different place entirely? I've met financial professionals whose personal wealth was almost entirely in real estate and private business, while they managed client portfolios of stocks and bonds. That asymmetry is telling. Question 3, what is the total cost? Not the advertised fee. The total cost? Mutual fund expense ratios, advisory management fees, trading costs, administrative charges, tax inefficiencies from turnover. When you add all of these together across a 30-year holding period, the number is frequently staggering, often consuming 20 to 30% or more of your ending portfolio value compared to a lower cost alternative. Now let me talk about what Rich Dad taught me the wealthy actually use financial professionals for. Because I'm not saying never use one, I'm saying use them correctly. The wealthy use attorneys, accountants, and financial strategists for very specific high-value purposes. Tax strategy, because the tax code is enormously complex, and the difference between a sophisticated tax strategy and a naive one can be worth hundreds of thousands of dollars over a lifetime Legal structuring, because how you hold assets, what entities you hold them in, and how you structure transactions matters enormously for both tax efficiency and liability. Protection and deal-specific analysis, having a trusted professional review a specific investment or transaction, not to manage your general wealth indefinitely, but to provide specific expertise for a specific decision. That is fundamentally different from paying someone 1% a year for the rest of your working life to keep your money in products they're compensated to sell. Rich Dad had a saying I've repeated for 30 years. If your financial advisor is richer than you, ask them how they got rich. If the answer involves managing other people's money, not their own investments, walk out of it. The Office. The rich get rich by owning things. The people who manage wealth for the rich get rich by managing. These are different paths, and only one of them is available to you inside a standard advisory relationship. Here are 3 specific practical steps. This is what I would do starting this week if I wanted to take genuine control of my financial future and stop being a passenger in someone else's vehicle. Step 1. Audit your current financial costs completely and honestly. This week, not someday, this week, pull out every financial product you currently hold, every mutual fund, every managed account, every insurance-based investment product. Find the expense ratio, the management fee, the load if there is one, and any other charges, add them together, then go to a fee calculator online and project what that total cost means over 10, 20, and 30 years in loss compounding. I guarantee most people who do this exercise are genuinely shocked, not because the individual fees sound large, they're designed not to. 1% sounds harmless, but 1% of a growing portfolio compounded over decades is not a small number. It is a life-changing number, and seeing it clearly as a real dollar amount rather than a percentage changes how you think about it. Then ask yourself, what is this cost buying me? Is it buying me access to investments I couldn't access otherwise? Is it buying me genuine expertise that is improving my returns? Or is it buying me the illusion of professional management and the emotional comfort of not having to think about it? Comfort is not an investment return. Know what you're actually paying for. Step 2. Find a fee-only financial advisor for a one-time financial education session. Not to manage your money, not to run your portfolio, a specific paid engagement to have someone explain your full financial picture, your current tax situation, your asset allocation, your fee structure, your options, and to give you honest advice that is not connected to any product commission. Fee-only advisors exist. They are not the majority of the industry, but they exist, and they can be found through resources like the National Association of Personal Financial Advisors. Paying a flat fee for a genuine analysis of your situation with no product sales attached is one of the highest return uses of a few $100s I can recommend. What you will learn in that conversation about your real costs, your real options, and the gap between where you are and where your money could be is worth multiples of what you'll pay for. Pay for knowledge, not for management. Step 3. Begin acquiring at least one asset that your financial advisor cannot manage or earn a fee from. A rental property, a small business, physical gold or silver, a cash-flowing investment outside the traditional financial system, something that is yours, that produces income, and that no institution earns a percentage of, simply for existing in your portfolio. This is not about abandoning all professional advice or going entirely outside the system. It's about building the muscle of direct ownership. It's about experiencing firsthand what it feels like to own something that pays you without a management fee sitting between you and the income. When that first rental check arrives, or that first dividend from a stock you researched and bought directly, or that first piece of gold you hold in your hand, something changes. You stop thinking like a managed client. You start thinking like an investor, and that shift, more than any specific financial product, is what ultimately produces financial freedom. Own something that nobody takes a cut of, then own more. I want to address the part of you that feels defensive right now. Because some of you watching this have trusted financial advisors for years. You have good relationships with them. You believe they're doing right by you. And hearing me challenge that feels uncomfortable. Here's what I want you to understand. I'm not saying your advisor is dishonest. I'm saying the system they operate inside is structurally misaligned with your interests in specific, identifiable ways. Those two things can both be true simultaneously. A person can be decent, hardworking, and genuinely trying to help you while operating inside a structure that rewards behavior that doesn't fully serve you. That's not conspiracy. That's just how incentive systems work. Here's a deeper mindset shift I want you to make. The belief that financial expertise is something other people have and you don't. My poor dad believed this completely. He deferred to institutions. He trusted the system. He assumed that the professionals who had the credentials and the nice offices knew things he didn't, and that his job was to follow their guidance rather than to develop his own understanding. And the system absolutely, consistently, silently extracted value from that trust over decades. My rich dad had a completely different relationship with professional advice. He used professionals as tools, highly specific tools for highly specific purposes, while maintaining his own financial education and his own strategic judgment. He never outsourced his thinking. He asked his accountant, "What can I do legally to reduce my tax burden?" He didn't ask his accountant to manage his investments. He asked his attorney, "How should I structure this property acquisition?" He didn't ask his attorney to determine his investment strategy. Different tools, different purposes, clear distinctions. The belief I want to challenge most directly is this: I don't know enough about finance to manage my own financial direction. That belief, in my experience, is the most expensive belief a person can hold. Not because you need to become a professional, you don't, but because the minimum financial literacy required to ask good questions, to evaluate advice critically, and to identify when incentives are misaligned is absolutely acquirable by any intelligent adult willing to invest time in learning it. Financial education is not a luxury, it is the foundation. Everything else is built on top of it. Let me tell you what is happening in the economy right now and why the decisions you make in the next few years will matter more than in almost any equivalent period in your lifetime. The traditional retirement model is under serious stress. Social Security's own actuaries project trust fund challenges within the next decade. Under current trajectories, corporate pension plans, once a bedrock of middle-class retirement security, have been largely replaced by 401ks, shifting the investment risk entirely onto you, the worker, and the 401k system, with its fee structures and limited investment options and dependence on decades of market performance, is not a guaranteed path to security. It is a hope. Inflation is persistent. The cost of housing, healthcare, education, and food has been rising faster than wages for most workers for years. The money you are accumulating in managed accounts is being measured in dollars, whose purchasing power's eroding. This is not a theoretical concern. This is happening now measurably in the prices you pay every week. Meanwhile, the financial services industry, managed funds, advisory practices, insurance products, collects fees through all market conditions: up markets, down markets, sideways markets. The fee machine does not pause during recessions. And over the course of a 40-year savings period, those fees compound into an enormous transfer of wealth from ordinary people who don't know what they're paying to institutions that benefit from that ignorance. The urgency is this: every year you spend inside a high-fee, passive financial management structure is a year of compounding, loss to fees, a year of inflation eroding your real returns, and a year of not building the kind of direct asset ownership that actually produces financial freedom. These years cannot be reclaimed. The math of compounding is brutal in both directions. It rewards those who start early and punishes those who start late. You are watching this video right now. That means you are paying attention. That is the first requirement. The second requirement is action, not tomorrow, not when you feel more ready, not after you've learned more. Action this week, even one step. Even the audit of your current fees I described earlier. Even one conversation with a fee-only advisor. Even 1 hour of research into an asset class outside the traditional system. The rich are not waiting. They never waited. And the gap between the financially free and the financially dependent grows every year that passes without action. Here's what I want you to carry out of this conversation. Your financial advisor may be a good person, but good intentions inside a misaligned incentive structure still produce outcomes that serve the institution more than they serve you. The solution is not to be anti-professional. The solution is to become financially educated enough to use professional advice correctly as a specific tool for specific purposes while maintaining your own strategic judgment and building assets that no institution takes a cut of. That shift from financial passenger to financial pilot is the difference between a retirement that depends on hoping the system worked out and one that is built on assets you own, income you control, and wealth you actually understand. Here's the one thing I want you to do today. Pull out your most recent financial statement, whatever account you have, whatever product you hold, and find the total annual cost, not the headline return number. The total cost, write it down as a dollar figure, then multiply it by 30. That is the approximate lifetime cost of that fee structure, assuming modest growth. Look at that number. Really look at it. Let it motivate you. My rich dad always said, the poor and middle class pay fees. The rich collect them. Stop paying, start collecting. If this conversation shifted something in how you see the financial advice you've been receiving, watch my next video. I'm going to walk you through the exact questions I asked before I put money anywhere and the ones that every financially free person should be asking too. Your financial future is not something to be managed by someone else. It is something to be built by you